Greetings to all, my name is Anna Kramarenko and today I'm going to speak about the investment portfolio management. The main issues that we consider today are the following. First, it's what is the essence of portfolio investments. Secondly is the types of investment portfolios. Thirdly, we consider the types of investment portfolio management. And the last 2 points, it is the consideration of Markovitz model and Sharpe model approaches, how to choose the certain stocks to provide the effective investment decisions. So the first is what is the essence of investment portfolio. An investment portfolio is understood as a set of several investment objects that are managed and as an independent investment object to achieve a set goal. When purchasing securities, an investor can pursue various goals, which can be conditionally combined into two main directions. First direction is direct investment. Second direction is portfolio investment. Direct investment is made by purchasing the necessary number of voting shares of an issuer and obtaining a share in the authorized capital of the joint stock company in order to gain control over the enterprise. Portfolio investment achieved when investor wants to receive income from a set of securities in any form at an acceptable level of risk. Portfolio investment has a number of advantages. First advantage is that portfolio investment allows to get an optimal combination of profitability and risk. Second advantage is that portfolio investments provides the relatively low cost compared to investing in real assets. And second advantage is that portfolio investments provides fairly high returns over a relatively short period of time. When forming the investment portfolio, every investor goes through several stages. First stage is development of investment policy. It involves, firstly, determining the purpose of investing money in securities. Secondly, comparing the goal and financial capabilities of the investor. And thirdly, comparing the goal set to the individual investor's attitude to risk. The second stage of the formation of investment portfolio is securities analysis. Securities analysis is aimed at identifying such securities that can ensure the achievement of set goal of forming portfolio. Investment attractiveness of securities is assessed according to the following criteria. First is investment security. It is how investment is protected from sharp fluctuations in the securities market and how the investment is stable of income generation. Third criteria for investment is return on investment. It depends on the growth of the market value of securities and the possibility of obtaining additional income. A third criteria to assess the investment attractiveness is liquidity of securities. It is the ability to quickly sell securities and turn them into the money without the significant losses for the investor. The next indicator to assess the investment attractiveness is method of income generation. For example, dividends on shares are not an obligation of the issuer. They are paid only if there is a net profit by decision of the general meeting of shareholders. but the coupon payments on bonds and their par value must be paid regardless of the financial condition of the issuer on the set dates. The next the criteria of investment attractiveness is the term of existence of a security. For bonds, the maturity period is set. Options and futures are urgent, but for shares this period is not set, and theoretically shares can exist indefinitely. The third stage, when investor form the investment portfolio, is the formation of investment portfolio through the acquisition of selected securities in certain proportions. After the purchasing the security, investor can restructure the invested portfolio due to the market situation. And this will be the fourth stage of formation of investment portfolio. Since the stock in the market are very dynamic and the changes can occur at any moment, these changes can affect the structure of investment portfolio. And the last stage is the evaluation of investment performance. Since any investor aims to receive the maximum profit, this stage is also important to provide the efficient investment decisions. The next question that we are going to consider today is the growth and income portfolios. So the most important types of investment portfolios. They are different due to the source of income that investor receives. First type is the growth portfolios. They are formed from the securities, and the main source of income for which is the growth of their market value. The purpose of this type of portfolio is to increase the value of portfolio. Growth portfolios are divided into several types. First are the high growth portfolio. They are aimed at maximum capital gains. The portfolio includes securities of fast-growing companies, and investments are quite risky, but at the same time they can bring the highest income. The second type of growth portfolio is moderate growth portfolio. They are least risky and consist mainly of securities of well-known companies, which are characterized by a low but stable growth rate of exchange value. And the next type of growth portfolio is medium growth portfolio, which is combination of investment properties of moderate and high growth portfolios. This guarantees an average capital gain and a moderate degree of risk. It is the most common portfolio model. As for the income portfolios, they are focused on obtaining high current income and contain securities, the main source of income for which in additional payments that are coupon payments on bonds and dividends on shares. Income portfolios should include stocks with stable dividends, bonds, and other securities that provide high current payouts. The purpose of creating such portfolios is to obtain a certain level of income, the value of which would correspond to an acceptable degree of risk. Income portfolios can also be divided into several types. First is fixed income portfolio that consists of highly reliable securities and generates average income within minimal risk. Second is high yield portfolio that includes high yield securities that generate high returns with an average level of risk. As a rule, investors prefer both ways of generating income on the securities of the portfolio and form so-called combined portfolios, which allow avoiding possible losses on the stock markets and both falling market value and low dividend and interest payments. Usually, investment portfolio management refers to a set of methods that provides saving original investment, achieving a highest possible level of profitability, and risk reduction. There are many methods of managing portfolio securities, and they are conventionally grouped into two directions: active portfolio management and passive portfolio management. Active portfolio management is associated with constant monitoring of securities market, the acquisition of the most effective securities, and the fastest possible disposal of low-yield securities. This type of management involves a fairly rapid change in the composition of investment portfolio. Active management is typical for experienced investors and highly qualified investment managers. It requires a good knowledge of the securities market and the ability to quickly navigate changes in market conditions. As for the passive portfolio management, it is the management of an investment portfolio that leads to the formation of a diversified portfolio that persists for a long time and is transformed only in the event of the significant deviations from the planned results of the current results. The direct dependence of the yields of the securities on risk allows using various mathematical and statistical methods to improve the efficiency of invested capital, and the Markovitz and Sharpe models are the most widely used in the stock portfolio. Firstly, we consider the basic assumptions of the Markovitz model. First assumption is that investment in portfolio of shares is carried out for one step of calculation or one holding period. At a certain point of time, the investor has a certain amount of money. This money must be invested in the selected portfolio of shares for the holding period. At the end of the holding period, the investor liquidates the portfolio or sells the shares of the portfolio. The second basic assumption is that securities markets are efficient. An effective securities market means a market in which the prices of financial instruments adequately reflect all incoming information and are brought into line with newly received information immediately. All information about the securities market is available to any investor. None of the investors is able to influence the prices of any financial assets. A third basic assumption of the Markovitz model is that information that affects stocks prices is random. This circumstance allows to apply the probability theory to study the securities market. And the fourth assumption is that the yield on the share is for the future holding period is likely to be equal to the average arithmetic value or arithmetic mean of the returns on these shares calculated for the past calculation steps. This arithmetic mean is called expected return of the stock. When forming the portfolio of the securities at the initial time, investor must take into account that yield of the portfolio securities for the future holding period should be comparable. Obviously, it is impossible to calculate this return since the investor does not know the share prices at the end of the holding period. This means that the yield of the portfolio securities for the future holding period can only be estimated. Markovitz model uses an objective method based on the assumption that the probability distribution of future expected values practically coincides with the probability distribution of already observed actual historical values. To get to know what is the essence of the Markovitz approach, Let's consider the typical example. We consider the three conditional firms A, B, and C, whose stock returns are given through 10 calculation steps are given here on the table. So we see the 10 calculation steps, 10 holding periods. During those periods, we see that there are different meanings of the level of the return for those three companies, A, B, and C. The next step is the calculation, the expected return or arithmetic average of the shares of all of the three firms. To do this, we use the tools of the Microsoft Excel. To do this, we open the Microsoft Excel file and copy the table with the data about the companies to this file. We see now on the screen, on your screen, that to calculate the expected return on the shares of company A, we put in the certain cell sign equal, then choose the function. The function that we choose is average, and then we underline all of the meanings of the returns for the company shares company A during the all 10 calculation steps. So now we calculate the average mean for the all returns for company A, and we have chosen the function and click OK, and we receive that the expected return or arithmetic mean for company A is equal to 0.1375, or in the percent rate it is 13.35% of the return. It is the average return for shares of company A. The same thing we do for the rest of the companies A, B, and C. And here on the slide you see the meanings of the return for companies A, B, and C. The highest expected return has the company C, which is 25.25%. But since the return of the estimated share for the future holding period is equal to the expected return only with a certain probability, it means that there is a risk that the realized return on the share calculated at the end of the future holding period will differ from the expected value. And the measure of this risk is the variance of the stock's return, which is now also can be calculated using the Microsoft Excel. In the line which we called variance, we choose the cell near the company A and put equal and choose the function var.s, which means variance. Now to calculate the variance, we should have a few numbers. Number 1 will be all the data for the return of the company A, and number 2 will be the expected return for the company A. Here on the slide you can see the numbers that we chosen to calculate the variance for company A shares. And then we click OK and receive the meanings of the variance. Here for company A, we do the same thing for the rest of the companies, and now on the slide you see the meanings of the variances for the other companies A, B, and C. But the variance does not measure the risk. The measurements of risk is performed using the standard deviation, which is the square root of the variance. That is why to calculate standard deviation, we find the square root from the variance. That is why in the line standard deviation we choose equal to the function square root sqrt in Microsoft Excel and choose the variance cell, for example, for company A. Here it's the cell B14. So and then we receive the meanings for standard deviation for all of the three companies. Now you can see on the slide then the highest standard deviation is for the company C, and this means that the highest risk of the highest probability that the real meaning of the return will differ from the expected return is for the company C, and the highest risk, investment risk, also is for the company C. And since often investor needs to choose a stock based on the rate of return and the risk, usually investor use two rules. First rule is if two stocks have the same expected return but different risk levels, the investor will choose the stock with the lower risk level. If a stock has the same level of risk but different expected returns, the investor will choose the stock with the higher expected return. But now we can see that the company C had the highest expected return but the highest risk. The company A had the lowest expected return but the lowest level of risk. How to do our decision, how to perform our investment decision in this case? Because in practice, as we see now in our example, higher yielding stocks often have a higher level of risk, and in this case the investment choice can be made using the CV deviation coefficient, which shows how much of the risk is accounted by 1% of expected return. The deviation coefficient is calculated as the standard deviation risk divided by the expected returns. Now we calculated on these slides the deviation coefficients for all of these three companies, dividing the standard deviation by the expected returns for each company, and we received that the lowest level of deviation coefficient has company B. That is why in this case we should prefer to invest the company B, choose the shares of company B. The next approach that we consider today is the Sharpe model. The Sharpe model is based on the linear regression analysis method that allows you to associate two random dependent variables, x and y, which a linear expression of the type y is equal alpha plus beta multiplied x. In the Sharpe model, the dependent variable y is the yield of the sum share of the portfolio measured for a selected calculation steps. The independent variable x is the value of a market indicator that affects the return on the portfolio shares. Such an indicator can be, for example, the growth rate of gross domestic product, the level of inflation, or the price index of consumer goods. Sharpe himself considered as independent variable the yield of the market portfolio calculated for the same calculation steps based on the Standard & Poor's index. To understand what is the essence of the Sharpe model approach, let's consider the same example with the same three firms A, B, and C, whose returns are shown in the table on the slides. And also here we add the the row with the market return that we find obtained from the open resources. And all of this market return also is calculated for the certain calculation steps as for the companies A, B, and C. To find parameters alpha and beta, we use the expressions that are showed on the slides. And firstly, alpha in the regression model is calculated as a difference between the expected value of the shares during the calculation periods and weighted expected value of market returns observed during the same calculation steps, where the weight of the weight is the parameter beta. At the same time, the parameter beta is calculated as a quotient of the covariance value of the shares and the covariance of the value of the market returns, and divided by the variance of the market yield. If we know the values of the market return, if we know the values of the returns on the shares of different companies during the certain periods of time, we can use the certain formulas and calculate the parameters alpha and beta and predict the changes in the shares return. What we are doing? First step, we add to our Microsoft documents the line which is called covariance. To calculate covariance that we need for all three companies A, B, and C, we choose in the certain cell the function covariance.s, and here we need also two numbers. Number one will be all underlined meanings of the returns of company A, and number two will be all the market returns. After putting these numbers into the function of covariance, we receive the meanings of covariance for all of three companies A, B, and C. We're doing this by the same way. The meaning of the covariance for companies A, B, and C are given here on the slide. The next step is calculation parameter beta. As you see here, beta is calculated as covariance divided by the variance. We do it in the same way for all the companies A, B, and C, and receive the certain results for the company for the company A, B, and C, the parameter beta. The next step is calculation of the parameter alpha. It is calculated as expected return for the certain company minus parameter beta multiplied the expected market return. And here on the slide we see the expression how to find parameter alpha for all of the companies, for example for company A, and here the meanings of this parameter that we are calculated. And now having such parameters, we can put them and calculate the future return on the certain shares and choose the share that provide us the highest return and make our choice. So future return is calculated as a parameter alpha plus the parameter beta multiplied by the last meaning of the market return. When we put all of the data due to this calculation, we can calculate the future return in the end of the holding periods for all of the companies A, B, and C. And here we see that future return for company C is the highest. That is why in this case we should choose company C for investment, because this company in future, regardless the different fluctuations, provide the highest possible income for the investor. On this point, I wish you good luck and wish you always to take the effective investment decisions.